Hey, what's up, everyone? Welcome back to my world of stocks. It's time for another wave of SEC filings pouring in from some of the biggest institutional investors in the world, showing us which stocks they've been buying most recently. And in today's video, we're going to be kicking it off with the biggest, absolute largest asset management company in the entire world, in the notorious BlackRock, who holds many trillions of dollars in the market. And they just purchased many billions of dollars more worth of stocks just in the last quarter alone. So we're going to run through some of their largest pickups, 5 in total for today. And as always, I'll give you my own opinion on each one of them, and I'll even rank them from best to worst too, based on that opinion. So smash that like button, subscribe if you haven't already. Really helps keep my channel alive, and I do appreciate that support, my friends. Really means a lot to me. Thank you for that. But with all that said, let's just go ahead and jump straight into this list. We've got it sorted here by percentage increase. We'll start with the smallest of the bunch first, and that was in RTX Corporation, ticker symbol RTX, which BlackRock increased their position on by only less than 3%, yet it still equates to about $440 million worth of purchases during the third quarter alone. Now, if RTX does sound a little unfamiliar to you, it's probably because the company actually changed their name from Raytheon a little while back, which I'm sure rings a bigger bell for being, one of the largest aerospace and military defense contractors in the world. So, given their size, it's not too surprising to see the largest asset manager also wanting a piece of that, let's call it an unfortunately very lucrative pie, as the world continues to experience very tragic wars and conflicts all over globally, especially in the Eastern Europe and Middle Eastern regions, where we've seen, just a lot of really tragic stuff occurring there between, Ukraine and Russia, as well as Israel and Palestine and other regional rivals like Iran, which America has even considered further military action against too. Not to mention that all the rising tensions with China and even some escalations down south with Venezuela are only making the demand for rockets and jets and weapons that Raytheon develops rise even higher. As a result, though, financials have been very strong for this company, where last quarter, in fact, their sales grew by 13%, their free cash flow more than doubled, and their backlog increased by double digits up to a staggering $250 billion. And they even raised their full-year guidance on both sales and profits too. Now, needless to say, the company is firing on all cylinders right now, but with that high of performance, so too comes a high stock price, one that continues to break new record highs after soaring about 50% so far this year. Now, as a result, valuation is also left trading about 50% more expensive than the sector, while the dividend is also sunk to just around 1.5% of a yield, although it does carry a fantastic payout ratio and growth history of more than 3 decades in a row. While most analysts still consider the stock to be a buy, though, the average price target is only about flat from where it trades today, which I think pretty accurately, I would say, reflects how I feel about this stock too. Long term, it's almost certainly going to be a reliable performer because I just don't see America's military budget ever going down. But with the stock price as high as it already is, I also just don't see as much gains potential from an investment perspective as I do with other stocks in the market that I just think are a little more attractively valued out there right now. And for that reason, I'm just going to rank them around the middle for now at number 3 while we see what else is on this list. But it's not a stock that I currently own myself. All right, moving on to the next purchase, though, we actually have another defense-related company, but this time it is in GE Aerospace, ticker symbol GE, which they added over $1 billion more of, and increasing their stake by over 5% during the quarter. Now, if you're not aware, this is actually the leftover business from a 3-way split following the breakup of the legacy giant corporation known as General Electric, where GE Healthcare spun out in 2023, GE Vernova, comprising the energy business, spun out in 2024, and then the company that remained is this one here, GE Aerospace, which held on to that original ticker symbol of GE, with investors getting shares of the other 2 companies after the split. Now, what's left over here, though, is actually their best performing business of the 3, focused primarily on engines and other aerospace technologies, which are being contracted by the US military too. In fact, it's estimated that about 2/3 of US military aircraft are actually powered by GE, who regularly wins large contracts from the US Department of Defense. Just back in March, for example, they were awarded another multi year contract worth $5 billion for their F 110 engines that power F 15 and F 16 fighter jets. As such, though, given all the ongoing conflicts and rising military spending, so too have GE's financials been on the rise. Last quarter, for example, their defense and propulsion segment saw a massive 75% rise in profits, helping lift the company's total sales by 26% and EPS by 44% year over year. Like RTX, though, the market is not unaware of this rising demand, and as such, so too has the stock skyrocketed recently, climbing over 50% this year, breaking new record highs, while in turn, the valuation has also spiked up to around a 100% premium over the sector on a forward PE basis. And while the PEG is a little better because of expected future growth, the dividend has also sunk to an almost non-existent level of just around 0.5% yield, which is probably why the average analyst out there now has a price target that is slightly lower than where the stock actually sits today. I don't personally own either of these two stocks, even though I do think they'll both see long-term success. But at the current moment, I just think that RTX maybe looks a little more attractive from an investment and even dividend perspective. So I will bump them up to number 2 so that I can put GE in its place at number 3, even though I think the two stocks are actually pretty similar. Purchase number 3, though, is really starting to make me think that BlackRock just put a large emphasis on defense type of companies this past quarter, because it was in the data management specialist known as Palantir Technologies, ticker symbol PLTR, who they picked up another $1.8 billion of during the quarter. Now, this being, of course, one of the hottest AI stocks at the moment, to which I've noted a couple times in prior videos that I really do think data will be the new oil of the 21st century. And if anyone's going to be the best at maybe refining all of that oil, I believe it'll be Palantir, who's an absolute specialist at gathering, managing, analyzing, and just really converting all of that data into actionable solutions for both corporations as well as the US government and military, where they continue to see tremendous success. Now, last quarter, for example, was their best ever, with just their US commercial customer count alone growing a whopping 65% over the past year, while related sales jumped triple digits in the quarter, with over 200 new deals signed worth over $1 million each. Now, all of this is despite the economy facing numerous headwinds, from tariffs to inflation to interest rates and more. So the fact that companies are still swarming to Palantir services is a great sign, showing that there is actually tremendous real world value in what Palantir can offer them. For example, HSS was able to improve 45 minutes of manual work down to just 5 minutes using Palantir's AI solutions, while American Airlines saved tens of millions of dollars in less than a year, and BP is seeing triple-digit returns too. This type of performance is why Palantir's $1 million deals more than 2x'd in the quarter, while their $5 million deals 5x'd as well. And they even landed a new deal with arguably the most important AI player of all in NVIDIA, whose own CEO, Jensen Huang, called the Palantir ontology the single most important enterprise stack in the entire world. The same goes for their government and military business, where they continue to see large success and be awarded giant contracts seemingly all the time, including another $10 billion software and data contract recently with the US Army. Now, these are the reasons why, despite the stock being so insanely rich, it's still a bit hard to put a limit on what Palantir may achieve in the future. And it's why, despite the PEG of more than 3, it is around 80% higher than the sector median of around 1.8, I would still rank Palantir the highest on this list so far. Now, right now, their market cap is still less than $500 billion, and I actually think it'll break the $1 trillion mark long term. So it's why I continue to hold a large amount of Palantir stock myself. All right, now coming in at purchase number 4, we do finally actually have a break off now from the military and defense names that we've seen so far, and that's in a stock that I've actually wanted to own for some time myself too, but I haven't pulled the trigger on it. But that stock is Intuit, ticker symbol INTU, which BlackRock increased their position on by over 6%, adding another $1.2 billion worth during the quarter. And the reason I say I've always wanted to own some of this one myself is because there's a lot to love about Intuit's business, and especially in how sticky it's become, with them not only being, by far the largest provider of tax software in TurboTax, which I actually use myself, and I feel that it's a great platform, But more importantly, they've built off of that success by developing an entire ecosystem, really, of other apps and services around it that make the entire suite just much more attractive and sticky. And that's including things like QuickBooks, Credit Karma, MailChimp, and more that together offer a complete ecosystem of fintech solutions for not just consumers, but also businesses and even government and more. Plus, there's a lot of growth to still be had, not just by integrating artificial intelligence, which will make their services even more efficient and more profitable too, but they've also been expanding further globally, where there's still a giant user base to tap into, since at the moment they claim to have only captured around 5% so far of their total addressable market. And because this is primarily a software based company, they also stand to not only grow their top line, but expand heavily on the bottom line too, thanks to those software like margins. And as such, both their sales and profits are expected to soar in the coming years, which is all reason enough, I would say, to really be buying the stock here. However, it's just the valuation alone that still keeps me at bay, at least for now, as the stock climbing over 560% in the past decade. It's left their PE and PEG ratios around 20 to 30% higher than the sector. I'm not saying that that's a terrible valuation at those levels. Maybe it's even pretty well justified for a company like this. And actually, I think that BlackRock buying the stock right now, maybe a little bit ahead of the upcoming tax season, which I do think will be upon us sooner than you expect. Right? It always just kind of creeps up on us. I know it does for me. And so, making moves on the stock now may be a good idea, and especially just as a long-term hold, I do think that it will perform very well for them. But I just feel that there's maybe a little more upside opportunity with other names out there in the market that I've been buying more so recently that I just think are a little more attractively valued. So it's going to be a pass for me. But as far as ranking it, I'm actually going to use Intuit to break up the big three defense plays that we've had so far. So I'll put them at number 3, just ahead of GE, but still behind RTX. All right, last stock on the list. The biggest purchase of all was in a stock that I've actually never covered before on the channel, so it's a bit of an interesting one here, but that is in a company that is called AppLovin Corporation, ticker symbol APP, APP, which they increased their position on by a whopping 31% in the quarter, adding over $3.2 billion worth. Now, if you've never heard of this company, they're basically an advertising technology or ad tech giant running a pretty large platform that helps businesses, especially mobile app developers, to advertise and monetize their apps. And they've done this also with television, but primarily apps is where they're seeing a lot of growth right now. And the real story here, though, I would say is, and it's definitely the reason why the stock has been soaring by as much as it has, is because of their AI-powered advertising engine. They call it Axon 2.0. It's really been a game changer for the company since launch because it uses AI to really optimize ad placements in the best areas possible. And it's done so effectively that it's actually been driving a big surge in their profitability while also helping advertisers navigate the new privacy rules that has really been kind of plaguing that entire area of the market. Now, this performance has been so strong for them, though, that in fact the company was even added to the S&P 500 back in September. So that really big sign of confidence there, vote of confidence, and a great sign for them. And in the latest quarter, for example, they also saw revenues soar by a whopping 68% year over year, while their adjusted EBITDA grew 79% on incredible margins of 82% as well. If this type of performance continues, which analysts do expect to occur on both the top and bottom line in the coming years, then so too should the stock keep climbing despite already having skyrocketed by over 800% since IPOing back in 2021. And as such, the valuation looks very expensive on more current PE metrics, while also still being considerably cheaper on more forward-looking ones like the PEG ratio factors in future years of growth. It actually sits 38% lower than the sector, if you can believe it. It's not a stock that I own myself yet, but I must admit that it's been climbing a bit higher on my radar more recently because they're actually going through a little bit of a dip that is starting to entice me a little more and making me think about at least maybe making a small bet on it. But so far, I haven't purchased the stock. I'll definitely let you guys know if I ever do. But in terms of ranking it, I am going to put them pretty high here at number 2, although I cannot put them any higher than that because I do like Palantir more. And I actually think this one is maybe a little more speculative than some of the other names on this list, but it is the one that I guess catches my interest the most out of the others. So yeah, it just kind of fits right there, I would say. Anyway, there you have it, guys. Those are my rankings. Let me know what you think about all of these purchases down below. As for me, I think they're all very solid names, especially if we're thinking about their long-term potential. But they're also, I would say all of them are trading at significant premiums to the sector at this moment. And even the one that I ranked the highest among all of them in Palantir just happens to be the most expensive of all, which is really saying something there. Again, I just think that there are safer options out there in the market at other valuations to consider right now, to where I wouldn't necessarily want to be chasing up some of these names here. But I can understand why it matters a bit less to someone as large as BlackRock. Anyway, that'll do it for this episode, and I'll have plenty more for you soon. So make sure you are subscribed. But I will catch you in the next one, guys. I hope you're all doing well, and take care, my friends. I'll see you next time. Bye-bye.